Hello and welcome to this video. Today is the 3rd of Jan 2019. Happy New Year again. Yesterday we had some really exaggerated market moves, and I thought this is a good opportunity to remind everyone of the actual realities in the foreign exchange market, as I've explained for quite some time now, as I've demonstrated in many other videos, in live trade videos, etc., etc. Okay, so what's the official explanation for the big market moves yesterday in dollar yen, other yen pairs, and even in pairs such as Australian dollar and Kiwi? Well, the official explanation is it's a flash crash. We had such an event also in 2016. They appear on a regular basis. People on the internet try to come up with all kinds of reasons without actually knowing what the reasons are. We have a similar situation when there's, for example, a so-called fat finger effect. And my point is that all these explanations, all these theories, unfortunately, they are a little more than a ludic fallacy, as Nassim Taleb would call them. In retrospect, people are trying to explain to themselves why there were these huge market moves. And as it is known, most people fall for the lie that the foreign exchange market would be driven by demand and supply, which is not the case. I have shown in detail. Rather than that, we have the situation where the markets are completely manipulated by the so-called smart money algorithms who work in a cartel structure. And as you can imagine, those big market moves are no exception to that kind of market structure on a micro and macro level. I call this market causality, as it is known. And I will show you now that by accident, as it appears, of course it's not accident, it's full causality, those supposed flash crashes are nothing else than exaggerated stop runs against the down money positions. And it's not difficult to show this to you. So here, for example, we have dollar yen. We see a massive move to the downside. This after a multi-week downtrend, and look what is actually happening here. So the down money was long, which is represented by those bars here. Overall, it was long. The stops were below the lows, also on the day charts. So this is a 4-hour chart. So basically, the smart money algos conducted a massive stop run to the downside, taking out all the medium term and also long term stops of the down money long positions, kicking them off the market, imposing margin calls on them, etc., etc. And we can see this so-called down money killing with this collapse here. After that big move, a lot of down money had to close in loss. And then it bounced back. We see that often. Also here in other markets, this is a day chart of Australian dollar, and look what's going on. Down money was long, bought even more, boom, exaggerated move, pin, stop run, taking out all the stops, killing them. This is a day chart of Kiwi dollar, same story. Okay, down money is long, boom, smart money conducts an exaggerated stop run to the downside. This is not coincidence, it's not an accident, it's completely under control of the smart money algorithms. This is a pound yen 50-minute chart from yesterday, and guess what? Boom, down money was long. This is let me see, a euro yen chart. Boom, down money was long. This is a dollar yen chart on a 15-minute time frame. Boom, down money was long. The stops were taken. This is even pound dollar on a 15-minute time frame, and guess what? Down money was long, so boom, they just went with it, took out those empty stop accumulations, and smashed back up. So yeah, it just shows once more what I've been showing for several years now. People who are familiar with my work, who have followed me, they understand what's going on. The market causality represents the actual reality in foreign exchange. It's not that if there's more demand than supply, the price goes up. It's rather that if there are more dumb money long traders than short traders, the smart money algo cartel detects it and moves the price against them, going for the stops and playing this game. There are certain principles I've demonstrated in other videos, such as time and range, such as plausibility, such as the pre-counter-run principle, etc., etc. I will not go into detail. I just wanted to make this short video to remind everyone that all these kind of moves are a result of the market manipulation, which is done by the smart money algos, by the cartel, and at the expense of all the dumb money traders on the buy side. Okay, and if you still believe in supply and demand, you really do not understand what's actually going on. The market causality is the reality. I have documented it over a long period now. It's all there for you to look at, to analyze, to understand. Unfortunately, people will always come up with other explanations. It's Apple in terms of the earnings. It's China in terms of a trade war. Dollar yen is an indicator for the overall market. And so on and so on. But actually, when you understand and see the market structure, it's not difficult to see what's played here. And those are situations where it cannot get any more obvious. So, I mean, it's not a coincidence. Okay. I think I made my point here. Stay safe. Invest time in understanding and studying the market structure. Okay. If you are a trader, make sure that whatever you do, whether it's manual trading or systematic or automated, whatever it is, that all these realities are somewhat incorporated into your approach. Because if that's not the case, then there's a high chance you will eventually end up on the dumb money side and fall victim to those smart money games, which are very, very unfair, which lead to huge losses on the dumb money side. All the best.